Many of you have asked me for an update on Hims and Hers Health. The stock is up 58% over the last months. It's been an absolutely mind blowing recovery on the stock. And if the stock keeps on going up, you're going to see more and more people all of the sudden bullish on Hims. But when Hims was going down to $15, $14, there were not a lot of bullish people left. People were finding reasons to sell the stock, the CEO, whatever, even though they said they're long term investors and they believe in the company. And I was one of the few people still getting mean comments at $15 and still believing in the company. So that was a really good comeback in general. But if we look at Hims, a lot of things have been improving. The sentiment has been changing in general amongst a lot of analysts. Like very recently, it got upgraded from $29 to $39 because a lot of data is showing a major inflection point after the NVO partnership. And this is the credit card data for Hims. I'm not a big believer in the credit card data because they miss a lot of things. But if we look at the credit card data so far, Hims has been absolutely killing it. A massive, massive recovery versus RO Health. It's ahead of RO Health again. It's also ahead of RO Health on a lot of the platforms like App Store and Google Play and all those stores. So things have been getting better for Hims in general. Short interest has been coming down. And this is really good because less and less people are finding a reason to be shorting Hims. Whenever you have high short interest on a stock, you always have to ask the question why. Because a lot of those short sellers are smart, you could say, and they have a reason to short the stock. So around 27% right now is still high in terms of a short interest on Hims. But the fact that it's been going down from 45% to almost 25% is very encouraging that people are finding less of a reason to be short Hims and Hers Health. Now, the story with Hims and Hers is they've been doing really well. Every single quarter, they increase revenues steadily. Then the revenue growth here has massively accelerated when they were selling compounded GLP-1s due to the shortage. There was a shortage, they are allowed to mass sell GLP-1s. Then the shortage ended, they stopped selling mass selling GLP-1 in March 2025, and since then their revenues has peaked. And I would call it more of a reversion to the mean, back to normal kind of growth. When you had such an overextended period of growth due to a one-time event, this one-time event is gone, so you're having a normalization in revenues. And this is why I've been saying this is more of a one-time event, and I think revenue growth will likely re-accelerate from here in a major, major way. But right now with Hims, you don't really have any major, what I would say, FDA risk or regulatory risk because they're no longer fighting Big Pharma. They're actually partnering with Big Pharma. And after Hims stopped selling the compounded GLP-1s, they're no longer getting a lot of those notice letters from the FDA. In fact, the FDA sent about 25 warning letters to a lot of telehealth companies on compounded GLP-1s, but Hims was not one of those 25 because they're no longer compounding GLP-1 and they're selling FDA-approved medicine. It's not a large margin for them, but it's a way to get people on the platform. And once they get on the platform for the NVO pill or the Lilly pill, then Hims can cross-sell them the labs products, the hair product, something within skincare and longevity, which they're getting into, mental health, and a lot of the things that they have. So this is more of a marketing funnel than a revenue-generating product for Hims. But the second argument around the earnings report was mainly their EBITDA margin. So their EBITDA margin has been crashing from about 16%, 13, 11, and 7%. And I said the Hims report was not too bad. And I got so many angry people in the comments. How come could you say the report was not bad? Well, yes, they had 7% in EBITDA margin. This is really bad, largely due to a lot of one-time events, but their guidance is 11% for 2026. So they're expecting EBITDA margin to normalize and get to about 11% for the full year, which is why the 7% for me wasn't really concerning. As long as EBITDA margin is between 11 to 13%, I am not too concerned with Hims and Hers Health. And now, again, you have a completely different company global company, not just United States. You have Europe, Canada. Those are new markets for Hims and Hers. You have Australia and Japan with recent acquisitions that just closed. So those are massive TAMs for Hims, and they can replicate US success in other markets. And again, that's really, really good for the company. International growth has been booming like crazy. It's up 10x over the last year, and that does not include the big acquisition of Eucalyptus. And Eucalyptus has 450 million in revenues, and it closed much earlier than expected in 2026. So again, there's so many, you could say, catalysts, so many call options to re-accelerate the growth in Hims and Hers Health, not even including the peptides market, which Barron's is projecting Hims and Hers to get a big chunk of the $2.2 billion peptide markets. And as the government launches more and more of those peptides, they're allowed to sell them. Hims has a peptides lab, and it will likely take a massive market share, and that could be the next big story for Hims and Hers after the compounded GLP-1 story. Now, if I look at how much I'm paying for all those things, I'm paying about 2 times sales. 2 times sales is ridiculously cheap for the stock. It got as low as 1 time sales. It was ridiculous. Now trading at about 2 times sales for a founder CEO. You get exposure to telehealth and healthcare in general in an innovative way, not just in the United States, but globally. 2 times sales is really not expensive at all for Hims and Hers Health. And this is my upside potential on the stock. I'm using the company's guidance of $6.5 billion in revenue by 2030. And we take the $6.5 billion and we use 3 times sales and 5 times sales, which I believe are good assumptions. I'm not going to use 1 or 2 times sales. I think would be ridiculous. But let's take the $6.5 billion and we time it by 3 times sales. This is about a $19.5 billion market cap. The current market cap, is like $8 billion. This is about 143% on the upside. And then you have some convertibles and other things. So you could say about 100% or a double over the next 4 years. This is not a bad return at all. Now we take the better case scenario, which is about 5 times sales, and we take $6.5 billion. We time it by 5 times sales. This is about a $32 billion market cap. The current market cap on Hims is about $8 billion, which is about a 300% on the upside over the next 4 years for an amazing company like Hims and Hers. So I still own the stock. I haven't sold the stock on the way down. I didn't capitulate. I didn't sell the bottom. I'm still holding my shares from about $7 per share. And I like the stock for the long term as a healthcare exposure. I don't believe the stock is overvalued. I think if it gets over $50 per share, then it starts to get overvalued. But for now, I think Hims is undervalued. And you have a lot of call options with the new acquisition, with peptides, and with many different things like wearables and other things that the company is looking into. So that was my opinion on the stock. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.